Good morning everyone. This is Kanimoli, Assistant Professor, Department of Commerce, Sri Shaktigala Women's College, Salem. In today's session, we are going to discuss about income from house property. First, we should know about the meaning of house property. Section 22 of Income Tax Act 1961 deals with house property income. The income from house property, buildings, bungalows, godowns, etc., to be computed and assessed to tax under the head income from house property. Then we move on some basic terms used in house property. First term is actual rent. It is the actually received by the owner from the tenant. Then composite rent. Composite rent refers to the total amount received by the owner from the tenant, including the services provided by the owner. The services may be lift maintenance, pump maintenance, water maintenance, etc. Then fair rental value. Fair rental value refers to the rent of similar type of house in the same locality. Then municipal rental value. Municipal rental value refers the rent which is fixed by the municipality is called municipal rental value. And then standard rent. The rent which is fixed under the Rent Control Act is called standard rent. Then we move on unrealized rent. It refers to the rent not recorded from the tenant is called unrealized rent. This unrealized rent can be reduced from the annual rental value. Then vacancy period rent. It refers to the rent for the period during which let out property has remained vacant in the previous year. Then gross annual value. Gross annual value refers to the value which the owner receives before allowing any deductions. Then net annual value. It is the amount available after deducting municipal tax or local tax paid by the owner from the annual value. Then municipal taxes. Municipal taxes can be deducted from the gross annual value only if it is paid by the owner during the previous year. If the municipal tax is paid by the tenant, which is not considered. Then we move on some exempted income from house property. The first exempted income is agricultural house property income. If the property is used for agricultural purpose, it is fully exempted from tax. Then house property held for charitable purpose. Then self-occupied. House used for own business or profession. Property held by registered trade union. House property held by a local authority. House property held by a scientific research institution. House property used for the purpose of political party. House property used for the purpose of educational institutions for spreading the education, not to earn profit. House property used for hospital or medical institution for the purpose of providing the service to the public. These incomes are exempted from tax. Next, we move on various types of house property. There are four types of house property. First one is let out house property. Second one is self-occupied house property. Third one is deemed to be let out. Fourth one is partly let out and partly self-occupied houses. First, we know about the how we have to calculate the income from house property for let out house. First, we have to take the gross annual value. From that gross annual value, we can less the municipal taxes paid by the owner. The answer we will get is net annual value. From that net annual value, we can reduce the deductions under section 24. There are two deductions under section 24. The first deduction is standard deduction. Standard deduction, we can calculate the standard deduction 30% of net annual value. And then we can calculate the interest on borrowed capital. This amount is also can be reduced under section 24. So further, interest on borrowed capital, we can have two deductions. First one is previous year interest. Second one is pre-completion interest. After that, we can add if there is any unrealized rent recovered and if there is any arrears of rent received. The final answer is taxable income from house property. Then here we have some steps to calculate the gross annual value. The step 1 is under step 1 we can consider the municipal rental value and fair rental value. The both figures should be compared. The higher value is taken as notional rent. This is called step 1 answer. And then we go for step 2. In step 2 we should compare the two figures, that is step 1 answer and standard rent. In these two figures, which one is less is taken as expected rent. This is also called step 2 answer. The step 2 answer is taken for step 3. In step 3, we should compare the step 2 answer with the actual trend. In step 3, the both figures will be compared, and whichever is higher is taken as GAV before vacancy loss. From that GAV, we can reduce the vacancy period loss. After that, we can get the gross annual value after vacancy loss. And then we move on self-occupied houses. Calculation of income from self-occupied houses. In this, first we have to take the gross annual value. Gross annual value for self-occupied houses always nil. From that, we can reduce the deductions under section 24. There are only one deduction for self-occupied houses, that is interest on borrowed capital. So the final answer we will get is loss from we can get the always loss from self-occupied house property. And then we move on deduction under section 24. So we already discussed about the deductions under section 24. There are two houses, that is let out and self-occupied. For let out property, we can have a 30% standard deduction, and in case of self-occupied property, there is no standard deduction. And then we move on interest on money borrowed for house loan. So first, for let out property, there is no maximum limit. If we pay n number interest, we can reduce that amount from the net annual value. And then for a self-occupied property, there is a restriction. If loan is taken before 1/4/1999, interest on loan taken is allowed up to rupees maximum of 30,000. If the loan is taken after 1/4/1999, we can have a deduction of rupees 2 lakhs. And then we move on pre-construction period interest. So interest for pre-construction period shall be allowed as deduction in 5 equal installments starting from the previous year in which the house is acquired or the construction is completed, and for the next 4 previous years. Thank you for listening the session.